Today is Tuesday, March 10th, 2026, and what I watched unfold in this morning's session was the single most unambiguous confirmation I have ever recorded that silver is not lagging. Silver is being held. There is a ceiling sitting directly above where silver trades, and this morning, that ceiling showed itself in real time. Crude oil detonated at the open, briefly tagging $119 a barrel before getting smashed back down toward $94. Gold rocketed to $5,200, then took a $200 hammer to the face inside the same session. Silver touched $85 at the open, the exact wall I have been marking on charts for the past several weeks, and got shoved back down toward $80 before slowly clawing its way back to current levels. Everything exploded higher. Everything collapsed lower, and by the time the smoke cleared, every single asset was sitting almost exactly where it started. The reason has been the same reason for months: the dollar. Every single time precious metals build momentum and attempt to break out, dollar strength surges on safe haven inflows and puts a lid on the move. That is the pattern. But here's what every person watching this needs to understand about structural ceilings. They do not last forever, and when this particular ceiling finally gives way, silver does not catch up gently. It reprices violently. The chart I'm about to walk you through tells you precisely how violent that repricing is going to be. The numbers I'm going to give you will sound extreme. I almost did not film this video because of how far outside consensus these targets are. But the arithmetic is the arithmetic. I'm going to show you every single calculation, and you are going to be able to verify all of it yourself. The chart I have been studying for years, the one that tells you exactly where silver goes when the dollar headwind finally snaps, is not a moving average crossover. It is not a candlestick formation. It is not volume profile or Fibonacci retracement. It is the gold to silver ratio. And right now, this chart is doing something it has not done in 15 years. Let me give you the current numbers first, because everything that follows is built on them. As of today, Monday, March 9th, 2026, gold is trading at $5,132.80. Silver is trading at $86.81. That puts the ratio at 59.1. Roughly 59 ounces of silver are required to purchase a single ounce of gold. When the ratio falls, silver is outpacing gold. Silver is gaining ground. When the ratio rises, gold is pulling ahead and silver is falling behind. Now here is the most important piece of context you need before we go any further. In the early stages of every single precious metals bull market in modern financial history, gold leads. It always leads. Central banks accumulate gold, not silver. The sovereign safe haven bid moves into gold before it flows anywhere else. That is not a theory. That is exactly the sequence that has played out in this current cycle, and it has played out exactly on schedule. Gold moved from roughly $2,000 to above $5,000. Silver moved from around $20 to a peak of $121. Both extraordinary moves. But gold led the entire way. The ratio is now telling you that the second phase of this bull market, the phase where silver catches gold and then runs past it, has not happened yet. And critically, the chart is telling you that phase is now sitting directly in front of us. Pull up a weekly chart of the gold to silver ratio going back to 2011. What you're looking at is one of the most powerful macro compression setups in the entire history of precious metals markets. In 2011, the ratio hit its cycle low at approximately 32. Silver was trading at $49. Gold was being outrun. That was the last time silver truly dominated this market with conviction. Then, the ratio climbed for years as gold held relative strength through multiple market cycles. It peaked in March 2020 at approximately 125 during the liquidity crash. At that extreme, it required 125 ounces of silver to match the value of a single ounce of gold. Silver was trading as if it were essentially a worthless industrial byproduct relative to its monetary peer. Since that 2020 peak, the ratio has been in a clear structural downtrend. Lower highs, lower lows. A descending channel that has been compressing for 5 consecutive years without interruption. And right now at 59, the ratio is sitting directly on the descending trend line that has defined the entire structure since 2020. Now draw the second line. Connect the major lows from 2011 forward. Through every cycle, low the ratio has printed. That ascending support line, running from 2011 through the current structure, is now converging with the descending resistance line from 2020. 2 massive multi-year trend lines built on 15 years of market data are meeting at a single point on the chart. That convergence zone is precisely where we are trading today, somewhere between 55 and 65 on the ratio. The chart has been squeezed into a narrowing range between 2 enormous structural forces. Price compressed between 2 15-year structures cannot hold that position. Something breaks. And everything in the data tells me exactly which direction it breaks. The first downside target on the ratio is 40. And I want to be precise here because this is not an arbitrary number I selected to make the thesis sound compelling. 40 is not a round number I threw at a chart and hoped it stuck. 40 is where the previous major support zone sits. The ratio tested the low 40s multiple times during the 2010 through 2012 period. It held there across different market conditions, different Federal Reserve policy environments, different geopolitical backdrops. When a support zone holds across multiple years and multiple distinct market cycles, it becomes a magnet. It pulls price back toward it with increasing force the longer price stays elevated above it. And right now, this ratio is being pulled toward that level by forces I am going to show you in this section. But before I show you the forces, let me show you the math. Because the math is what makes this video different from every other silver analysis you are going to find. My first gold target is $6,000. Gold has been advancing in roughly 20% increments throughout this bull market. This is not speculation. This is pattern recognition built on a sequence that has already repeated itself 5 or 6 times within the current bull run. A 20% advance from current levels takes gold cleanly above $6,000. From $5,130, a 20% move lands at approximately $6,158. That is not an aggressive assumption. That is the pattern continuing exactly as it has been running. A pattern that has repeated 5 or 6 times in a single bull market is not coincidence. It is structure. It is the fingerprint of institutional accumulation playing out in predictable phases. Now apply the ratio math. $6,000 divided by a ratio of 40 equals $150 for silver, $150. That is 73% above where silver is trading this morning. And that is the conservative first target using the most modest ratio assumption available. The second calculation uses my higher gold target of $7,000. If gold makes 2 consecutive 20% advances from current levels, it arrives in the $7,000 range. That is not a stretch given the structure of this bull market. Now apply ratio math at a compression level of 25. 25 is not a level I invented. 25 is a level the ratio has reached in every single major silver bull market of the past 50 years. Everyone. The 1979 to 1980 run, the 2010 to 2011 run. In every cycle where silver truly ran, the ratio compressed toward 25 before the move exhausted itself. $7,000 divided by 25 equals $280 for silver. $280. That is more than 3 times where silver is trading right now at $86.84. And if gold overshoots its targets due to war escalation, accelerated dollar devaluation, or a sovereign debt event that forces a repricing of hard assets globally, if gold reaches $8,000 or $9,000, then silver at $350 is within the same ratio arithmetic. I would not be shocked by that number. The math supports it cleanly. Now, here's what I want to show you that I have not seen anyone else connect to the ratio thesis. This is where the analysis stops being a chart pattern exercise and starts being driven by physical reality on the ground. COMEX silver deliveries have just hit all-time records. The 12-month rolling average is sitting at approximately 43 million ounces. Monthly delivery spikes are reaching 75 to 80 million ounces. That is the highest physical delivery demand in nearly 20 years of recorded exchange data. At the same time, COMEX registered silver, which is the metal actually available and eligible for delivery, has plunged to 81 million ounces. And the total open interest on the exchange represents 294 million ounces of paper claims against that 81 million ounce registered inventory. That is 3.6 ounces of paper for every single physical ounce that is actually deliverable. 3.6 to 1. That mismatch is not a footnote. It is not a technicality buried in exchange data that only specialists care about. It is a structural fault line running directly underneath the entire silver market. And here is the connection that nobody is making loudly enough. The delivery surges are the actual mechanical engine of ratio compression. Every single ounce of silver that gets pulled out of COMEX through the delivery process goes into private hands permanently. It leaves the exchange. It is no longer available to be leased out. It is no longer available to be lent. It is no longer available to be used as the physical backing that allows short sellers to hold their positions against a rising price. The short sellers operating on COMEX depend on access to physical metal to back their paper positions. When that metal exits the building at record volume month after month, the structural foundation of those short positions is being quietly demolished beneath them. The 4 largest short sellers in the COMEX silver market have cut nearly half of their combined short positions since 2024. That is not a small adjustment. That is a major institutional retreat from a trade they have held for years. At the same time, JP Morgan alone took 3 million ounces in silver deliveries in January alone. Bank of America has been stopping hundreds of millions of dollars worth of gold contracts. The institutions that actually understand these markets from the inside, the ones with direct visibility into registered inventory levels in real time, are pulling physical metal out of the paper system at a pace that tells a complete story. They can see the delivery numbers. They can see the registered inventory falling. And they understand that holding a paper short position in a market where the physical backing for that position is being drained at record speed is a trade that ends only one way. The smart money is not debating ratio targets on financial media. They're not publishing research notes about whether $150 silver is realistic. They are pulling metal. As those short positions compress month after month, the artificial ceiling that has been suppressing silver weakens. Every month that delivery volumes hold at record levels is another month that the paper shorts lose another layer of structural support. The ceiling does not disappear overnight, but it develops cracks. And when a ceiling built on paper claims against a shrinking physical inventory finally fails, the ratio does not drift gently toward 40, it collapses there. Then it continues toward 25, and the targets follow directly from the arithmetic. I would be doing you a genuine disservice if I only showed you the case for silver moving higher. There is a legitimate argument on the other side of this trade. It deserves a real answer instead of dismissal, because the people making it are not fools. They are looking at real data and drawing a conclusion that has surface logic. So let me walk through the bear case completely and then show you exactly where the data breaks it. The first bear argument is a supply argument. Silver prices rise. Mining becomes more profitable. More silver gets produced. That increased supply puts a ceiling on the price. Silver is a commodity. It responds to price signals. And unlike gold, central banks do not hold silver in their reserves. There is no sovereign bid. There is no reserve asset designation giving it a permanent institutional floor. Remove the institutional demand floor and add a supply response. And the ratio compression thesis weakens considerably. That is the argument. It has some validity on its surface, but the data does not support the conclusion. Silver has been in a structural supply deficit for 5 consecutive years. Prices have quadrupled from their recent lows. The deficit is not closing. It is not even narrowing in any meaningful way. Refineries are running at capacity. Industrial consumption across solar panel manufacturing, semiconductor production, and defense electronics is growing faster than the mining industry can physically match it. And the reason the supply response is so slow is mechanical, not theoretical. Opening a brand new silver mine from initial discovery to first production takes between 7 and 10 years. Expanding existing production takes 3 to 5 years. You cannot mine silver from a deposit that has not been permitted yet. You cannot accelerate a permitting timeline that does not exist. No price signal, no matter how extreme, can compress that physical and regulatory reality into a timeline that matters for the ratio compression trade that is setting up right now. The supply response is structurally slow, the demand surge is happening in real time, and the COMEX delivery data I showed you confirms that available above-ground supply is being withdrawn at record speed simultaneously. Higher prices have not solved this deficit. They have not even slowed the rate of depletion. This is a structural supply gap, and structural supply gaps do not respond to price signals on a timeline that is relevant to what this chart is setting up to do. The second bear argument is that silver is not a monetary metal. Central banks buy gold, they do not buy silver. Without a sovereign bid underpinning it, silver cannot sustain the kind of repricing that gold achieves through reserve asset accumulation. Silver is an industrial metal with a speculative premium layered on top. I want to be honest about this point because it is the strongest part of the bear case. Central banks do not hold silver today. That asymmetry is real and it matters. But the conclusion the bears draw from it does not survive examination. Silver was added to the United States critical minerals list. That is not a monetary designation. It is a strategic and industrial designation. But in the current geopolitical environment, that classification means governments are treating silver as essential infrastructure rather than as a monetary relic. You cannot manufacture next-generation defense systems without silver. You cannot build out renewable energy infrastructure at the scale governments are currently mandating without silver. You cannot produce advanced medical equipment without silver. That is a demand floor that no central bank designation creates and no central bank designation can remove. And consider the more provocative version of this point. Central banks have not bought silver yet. That is a fact. But ask yourself a different question. What happens to the price on the day the first major central bank announces silver reserve holdings? The absence of sovereign buying today is not a reason to be bearish on silver. It is a reason to be positioned before that absence ends. History does not give you a warning bell before these regime shifts happen. You either own the metal before the announcement or you chase it after. I am not going to tell you this. Thesis has no failure modes. 3 scenarios could legitimately break it or delay it significantly. The first is the dollar does not turn. If the Federal Reserve maintains a restrictive policy posture and the dollar index holds structural strength for longer than the ratio math assumes, the ceiling on silver persists. The compression gets delayed. This does not change the eventual direction of the trade, but it changes the timeline materially. And a delayed trade that is levered or held in futures is a very different position than one held in physical metal with no expiration. The second failure mode is a global liquidity crisis. In 2020, silver was briefly destroyed before recovering. A severe recession or a credit event that forces institutional selling across all positions simultaneously could produce a sharp short-term flush, even with the long-term thesis completely intact. If you are holding physical metal, that flush is an opportunity. If you are holding leveraged paper positions, that flush could force you out before the trade resolves in your direction. Be clear about what you own and why before that scenario arrives, not during it. The third failure mode is a viable industrial substitute for silver emerging at scale. Copper-based or aluminum-based alternatives to silver in solar cell manufacturing and electronics have been in research and development for years. If a cost-competitive substitute reaches commercial deployment, it removes a significant portion of the structural demand argument. This is a real risk on a long enough timeline, but on the timeline relevant to the ratio compression trade currently setting up, no substitute is close enough to commercial scale to move the supply-demand needle. 3 failure modes, all real, all acknowledged. But none of them changes what the chart is showing right now. 2 15-year trend lines converging at a single point. A ratio sitting on descending resistance with ascending support rising underneath it. A physical market running the highest delivery volumes in 20 years against a registered inventory that has been gutted. And the largest short sellers in the market quietly cutting their exposure, while the largest institutions pull physical metal out of the exchange system at unprecedented pace. The ceiling exists. The data shows exactly why it exists, and the same data shows exactly what happens structurally when it finally fails. Let me bring everything together now, because the individual pieces of this analysis are compelling on their own, but it is when you see them operating simultaneously that the full picture comes into focus. You have a gold to silver ratio sitting at 59, compressed between 2 15-year trend lines that are converging at a single point in time. You have COMEX registered silver inventory at 81 million ounces against 294 million ounces of open paper claims. You have delivery volumes hitting all-time records with monthly spikes reaching 75 to 80 million ounces. You have the 4 largest short sellers cutting nearly half their combined positions since 2024. You have JP Morgan pulling 3 million ounces in physical deliveries in a single month. You have a structural supply deficit that has persisted for 5 consecutive years without closing. And you have gold trading at $5,132, while silver trades at $86.81, a ratio of 59 that the historical record says is deeply structurally wrong, relative to where silver belongs in a mature precious metals bull market. None of these data points exist in isolation. They are all feeding the same mechanism, and that mechanism has a name. It is called ratio compression. And ratio compression, when it arrives after this length and magnitude of suppression, does not move slowly. Let me show you the most recent example of this compression playing out in real time within this current cycle so you can see the velocity of what is coming. When gold moved from approximately $4,200 to $5,600, that was a move of roughly 33%. During that exact same window, silver moved from approximately $65 to $121. That was an 86% move in silver against a 33% gold advance. Silver moved 2.6 times faster than gold on a percentage basis during that single stretch, and the ratio compressed from approximately 65 to 46 during that same period. That is ratio compression playing out with real money in the current cycle, not historical theory, not a backtest from 1980. This cycle, this bull market, this exact same structural setup that is now resetting from a higher base. Now apply that same dynamic from where we stand today. The inputs driving the next compression are more extreme than they were when silver last moved 2.6 times faster than gold. The COMEX physical drain is at higher volume. The short positions being cut are larger. The supply deficit is deeper. The geopolitical demand for silver as critical infrastructure is greater. The ratio is starting from a higher level of 59, which means there's more compression potential remaining before it reaches either the 40 target or the 25 target. Every single variable that drove the last compression wave is more extreme today than it was at the start of that wave, which means the next compression cycle does not have to be weaker than the last one. The structural logic says it should be stronger. Now I want to address something that comes up every time silver analysis produces targets in the $150 to $280 range. The question is always the same. If the math is this clear and the setup is this obvious, why hasn't it happened already? Why is silver still sitting at $86 instead of running? The answer was visible this morning. I showed you the answer at the very start of this video. Crude oil hit $119 and collapsed back to $94 in a single session. Gold hit $5,200 and got hammered $200 lower before recovering. Silver touched $85 and got pushed straight back down toward $80. The dollar surged on safe haven flows every single time fear spiked. And that dollar strength capped every precious metals move before it could develop into a genuine breakout. The wall is not invisible. It is functioning in real time, in plain sight, in today's session data. But the wall is losing the physical silver that backs it, ounce by ounce, delivery by delivery, month after month. And a wall that is losing its foundation does not announce the day it falls. It holds, then it holds, then it holds again, and then it does not hold, and everything reprices simultaneously. That is the moment this entire setup has been building toward. And the ratio chart, the COMEX delivery data, and the institutional positioning data are all pointing at the same window. Here's what the positioning picture looks like on the ground right now. The institutions with the deepest visibility into this market, the ones who can read registered inventory levels in real time and who understand what record delivery volumes mean for the structural integrity of paper short positions, are not waiting for confirmation. They are not waiting for a technical breakout on a daily chart. They already know what the delivery data means. They are pulling metal now before the crowd arrives. JP Morgan taking 3 million ounces in a single month is not a hedge. It is a statement. Bank of America stopping hundreds of millions in gold contracts is not routine portfolio management. These are institutions reading the same registered inventory numbers you and I can read on the COMEX daily warehouse report. And they are drawing the only logical conclusion available from that data. The paper system that has suppressed silver for years runs on the assumption that registered inventory remains available, that leased metal remains accessible, and that short sellers can always access physical supply to manage their exposure. Every delivery that exits COMEX permanently removes one more ounce from that assumption. At 81 million ounces of registered silver against 294 million ounces of paper claims, that assumption is already running on a 3.6 to 1 fiction. And the fiction gets thinner every single month that delivery volumes hold at current record levels. Gold at $530, silver at 86.81, ratio at 59. Two 15-year trend lines meeting at a single point. The math says $150 is the conservative target. The math says $280 is where the ratio has gone in every major silver bull market of the past 50 years. The physical drain says the ceiling is structurally compromised. The institutional positioning says the smart money already knows how this resolves. Silver is not weak. Silver is trapped. And the data tells you exactly what happens when the trap finally breaks. If you found this analysis useful, hit subscribe and turn on notifications. This channel is where COMEX data, ratio charts, and real market mechanics get broken down without the noise. The next video is already in production. You do not want to miss it.